Hi, it's Ben Morton here, Head of Global Listed Infrastructure at Cohen & Steers. I'd like to talk to you today about listed infrastructure and the case for the asset class. We're seeing a lot more attention and interest in the asset class globally, and thought it would make sense to give a quick update in terms of what we're seeing. So first of all, secular drivers for the asset class remain the same: access to critical hard assets that underpin societies and economies. You all know that historical underinvestment, unfortunately, has led to some disastrous circumstances, collapses of bridges and tunnels around the world. We've seen that in Europe with the Genoa Bridge collapse. We know that here in the US, we've got antiquated distribution networks for things like water, and we've got issues like those seen in Flint, Michigan, and Newark, New Jersey. So historically, it's been governments, of course, that have been investing in infrastructure. But the case we've made for some time and continue to make is that government's going to be challenged to do so and do so effectively, and that investment will be made by private entities over time. So interesting opportunities for our companies will come. So we know of the differentiated performance profile of infrastructure that largely comes from the stability of cash flows of infrastructure businesses. I think that stability should be more valuable in uncertain times like the times we have today. We've historically seen sort of the outcome of that predictability be equity-like returns, but with lower volatility than broader equity markets, and most importantly, attractive downside capture of about 50%. The total return for the asset class remains similar to what we've seen in the past. High single digits comprised of a 3 to 4% dividend yield and 4 to 6% average long-term cash flow growth. So how do we think about this opportunity today? Certainly from a valuation perspective, we think the asset class is very attractive. A lot of that's driven by the year-to-date underperformance of infrastructure, where we believe some of that underperformance has been justified in certain subsectors, but some underperformance we believe is representative of a dislocation relative to the market's view compared to ours. So in any event, that underperformance has led infrastructure to trade as cheap as it has in 10 years relative to broader equities. So historically, infrastructure is traded at a 1 to 2 turn cash flow multiple premium to broader equities. Today it trades at a half a turn or a 1 turn discount to global equities. Again, at a time where we have significant uncertainty in the markets, we have lower rate for longer environment. This is a time when I think the market should be rewarding the relative predictability of infrastructure cash flows. I'd also note that the dry powder theme remains. $220 billion plus on the sidelines that's finding its way into the infrastructure market, some of that through purchases of listed assets, some through purchases of listed companies. So dry powder remains another lever of support for infrastructure and listed infrastructure businesses. So a few themes that are attractive to us today. First, digital transformation of economies is important and happening, and is a long-term secular driver of demand for cell tower companies and data centers. Transportation infrastructure has real leverage to activity resumption and economic improvement and growth. Of course, there's some bifurcation there when you look at some of the subsectors that are more sensitive to economic activity resumption and some that are more sensitive to travel restrictions and the easing of those restrictions over time. But certainly there will be opportunities for improvement in some of those businesses. And then utilities. We think utilities represent a real dislocation, underappreciated growth, frankly, with leverage to decarbonization themes, which we think the market has underappreciated. Reminder, what's unique about infrastructure is you can get some real dispersion of returns between subsectors, between specific stocks within subsectors, and between geographies. No year better than this year to tell you that, when you see pretty dramatic differences between different subsectors in terms of their performance. So great opportunity for active management to add value. So what are some of the drivers that we're seeing near term that I'd say this is a real opportunity? First, we're starting to see performance turn a little bit. September and October performance. Infrastructure has actually outperformed equities by about 3.5% over that nearly 2-month period, having underperformed materially for the first 9 months of the year, I should say the first 8 months of the year. Technology, which frankly became a defensive trade in a time of market uncertainty and volatility, is under threat. So think about 15% of the S&P is under antitrust investigation. These are true technology companies. I'm not talking about infrastructure companies leveraged to technology, but true technology companies we think about. So that threat probably leaves technology a little bit out of favor relative to how the companies have performed this year. I think that opens the door for infrastructure to regain its footing as an asset class that provides attractive downside capture. And lastly, we're seeing it. We're seeing it from institutions. We're seeing a lot of interest around the world, as I noted earlier. Consultants are making first-time recommended lists for infrastructure or growing those lists. And we're seeing, frankly, a lot of public funds here in the US make first-time allocations to infrastructure. So that's the quick update. Looking forward to talking to everybody either on updated quarterly calls or in person. Hopefully we can get together again. Thank you.